overview of Indian financial system. Okay, so the first thing that should come to our mind is what is the requirement of a financial system. Okay, so if you see, the main objective of an efficient financial system is to channelize resources. Okay, it's basically a system that is efficient in mobilizing resource. Okay, it should be the one which is able to mobilize any penny lying with anyone in this system. Okay, because we know as in economics that there is some income, okay, that the people would be earning, and when subtracting consumption, okay, we get the savings of that person. Okay, so there are people who have earned enough for consume less, but they are able to save some capital. They are called capital savers in the system. Okay, now the economics says all savings is equal to investments. Okay, all savings is equal to investments. Okay, all savings is equal to investments. Now, how is it possible? Okay, you have saved some money and the money is there with you. How is this money an investment? Okay, it's not an investment till the time it's kept idle. Okay, the easiest way of doubling your money is to fold it and put it in your pocket. Okay, the money does not grow on its own. The money grows, becomes an investment only if it is put to use. Okay, that means this money lying with any individual should be channelized, should be put to use. Okay, by people who are called deployers of capital, users of capital. Okay, unless and until this is not happening, your savings cannot be an investment. Okay, so if we have an efficient financial system, this financial system is able to do that. The financial system is able to channelize resources from savers of capital to deployers of capital. Okay, now it's one thing to understand this, but then it's your hard-earned money. Okay, you have earned more, consumed less. Okay, it's your money, it's your hard-earned money. Now it would not be just given to anyone because he's asking for. Any person who is a capital saver in the system would have an objective or a motive with the money that they have saved. Okay, not all money is with the motive that it should be given to anyone who is asking for, because the people who are capital savers, so we are saying that there are capital savers okay. Now these capital savers should have some motive with their money. Okay, they could have a motive that their capital should grow. Okay, that means they are willing to give money provided the capital has the potential of growing. They are willing to give 1,000 rupees if it becomes 2,000. If there are avenues like that in the system, they would probably be interested giving their savings to become an investment, or else they would not. Okay. Similarly, there are people who will have the motive with their capital to give a regular income. Okay, they want the capital to give a regular income. So if there are avenues, if there are products, if there are sources which probably is able to do that, then they are interested in giving the money, or else they would not. Okay, and there is huge set of people who has a motive with their capital to be preserved. Huge individuals. Okay, you take whatever, there are people who don't want to take risk. The main motive is that the 1,000 rupees should not become 999.99. Whether it becomes 1,001 is secondary for them. but it should not be eroding. Okay, huge set of people. If these requirements are not catered, the money that they have saved would not be available to be channelized. Okay, so an efficient financial system should be one which is able to mobilize all type of capitals with whichever motive that they might be having. So if your capital has a motive of growth, then we have capital growth assets. Okay, if your capital has a motive to give a regular income, then we have fixed income securities, fixed income investments, and then there is a capital preservative. Okay, because huge set of people are like that, because as far as considering risk is concerned in India, we all by nature are risk averse. Okay, we don't want to take risks. The best way of managing risk that we have been taught in our upbringing is to avoid it. Okay, so if there is anything risky, avoid it. That's what is the mindset. But then in finance, in financial matters, there is a bothersome correlation. Okay, the moment you avoid a risk, you also avoid potential returns, because risk and return goes hand in hand. Okay, so avoidance of risk cannot be a solution. But then there are people in the system. There are people in the system who would only give money if I see that my capital is preserved. Okay, so these three motives: capital growth, okay, capital income, and capital preservation. Unless and until these motives are served within the system, such type of capitals are not able to be channelized. Okay, so an efficient financial system is one which transfers resource from savers to deployers, and is able to do that by providing channels, okay, avenues, markets, instruments through which it's able to be possible for making savings and investments. Okay, now for this reason, that there are different type of motives with the capital lying with an individual, we have different types of market. Okay, so going further, if I see an Indian financial system would be broadly classified to be a money market, okay, and a capital market. Okay, now the very first thing that comes to mind is, why do we need this segregation? Okay, why do we need this segregation of two different markets? Okay, why can't one market serve the purpose? And the reason is because there are people who are providing capital to this through this system, channelizing through this system, have different motives with the capital. Okay, so money markets are meant for those who are money markets are meant for those, okay, who predominantly has a motive of, okay, capital saving. So we said that there's a Indian financial system, okay, which we said is efficient only if it's able to channelize resource, and we said there are two segments: money market and capital market. Now money market is predominantly for capital preservative class of asset providers. Okay, when we say capital preservation, we are talking of risk-free notion. That means the person is getting a notion that your capital is safe. Okay, it's risk-free. It's just a notion that is getting, because there's nothing in the universe which we can say is risk-free. Okay, but you get a notion that this is a place where I give money and my money is protected. Okay, now how do we get this notion? This is through the souvenir guarantee of Government of India, okay, and through RBI. So RBI along with Government of India gives you a souvenir guarantee that your money is safe with us. Okay. Now, unless and until this souvenir guarantee is not coming out, the people would be reluctant giving money, because they are only willing to give money provided the capital is preserved. Okay. Now, why do we need this segregation at the very first stage? Okay, as money market and capital market is predominantly because that there are different type of capital providers, and by nature there are a lot of people who are risk averse. So we need a separate institution, separate market, separate regulations to monitor that, because it's a risk-free market that we are talking. Okay, so when we talk about capital market, then capital market would be a market that predominantly would be risk-taking market. So if you want a capital to be growing, then you have to be also exposed to risk. Okay, so through Government of India's souvenir guarantee and through RBI's involvement, you get a kind of a risk-free notion in money market. Okay, now when we say risk here, we are talking of market risk. Okay, so if a money market instrument has promised you 8%, you'll get 8%. That's what government is guaranteeing you. Okay, that you give me 1,000 rupees, okay, you get 8% on that, come what may. Okay, if need be, I'll print new notes or do whatever requirement, increase my tax collections, but I would commit to my obligations. Although historically there have been economies where governments have been known to not been able to commit that, but then thankfully in India it's not so. Okay, so through that souvenir guarantee of Government of India, you get this notion that my capital is risk free. Okay. Now, since even RBI is not able to foresee long in future about the money supply or the dynamics of the economy, that's the reason why they review the monetary policy every 6 months. So they cannot be assured of a risk-free environment going long in future. Okay, and that's why we see that money market instruments are of short term. Okay, less than 1 year. Okay, so maximum maturing instrument in money market that we'll see is of 1 year. Okay, the most active ones are those which are again for a smaller duration. Okay, so very important to understand this at the very beginning, that an efficient financial system is the one which is able to channelize resource, but then the resource lying with individuals have different motives. So I need to have different setups, different mechanisms to fulfill all requirements or motives. So that is a market, money market, which is through Government of India giving you a souvenir guarantee that your money is safe. So if somebody has a motive that the money should be safe, okay, then they go to money market and they invest in money market instruments, and that way again his savings becomes channelized into the system, and it is able to be called as investment. Okay, and for other two type of capital providers, we have capital markets. So money market is for risk averse. Okay, and whereas capital market is for risk takers. Okay, who have the motive of the capital to be either capital to grow, so the capital should be invested in growth assets, or to give a regular income. Okay, so the capital should be giving a regular income. Okay, so by doing this, we are able to see this, that all the three type of capital providers or capital savers are being able to be channelized into the system. Okay, so that is how it is, that we need to understand that an efficient financial system is one which is able to channelize resource from the savers to the deployers. Okay, savers are those who have earned more or consumed less. They have surplus of money with them. That's why they're called savers of capital. But then a saving becomes investment only if it's been channelized, mobilized through an efficient financial system and the money is put to use. Okay. Now, this money lying with individuals would have different motives. We understood that there are people who would have the capital to give a regular income. They will have people who will have people who would have the motive with the capital to give a regular appreciation, and there will be a lot of people who want the capital to be preserved. Okay, unless until these three motives are not served, okay, we don't get an efficient system. So broadly speaking, we have a money market and a capital market. Okay, and they cater to this requirement. So money market is the market which channelizes, mobilizes the resources which are motive of capital preservation, and that is conveyed through a souvenir guarantee of Government of India and regulated by RBI, where you get a kind of a notion that money is safe in this market. Okay, and then we have a capital market which is able to give a growth or regular income to your investment, because unless and until you are exposed to risk, you probably don't get returns. Okay, so that is one broader classification that we need to understand. Okay, now going further, capital market is segregated in non-securities and securities market. Okay, non-securities and securities market. Now, why this segregation? Okay, continuing from what we have been understanding till now, that we have an efficient financial system to channelize resource, money market, because a lot of people who would have the motive of the money to be preserved. Capital market, as if you want your money to grow, to give a regular income or growth appreciation, you have a market. But then in capital market, there are a lot of instruments which are not securities. So what is securities? Okay. Now it's not any security firm that you're talking. It's not G4 securities or something. Okay. Securities in finance is any instrument which has a market for trading. If an instrument does not have a market for trading, it doesn't become a securities. Okay. So that's why we need to have this segregation, because there are a lot of instruments which serve the purpose of capital market, which gives you a growth in your capital, appreciation of capital, or could give you regular income on your capital, but it does not have a market for trading. Okay. So if it is an instrument which only has the new market, first time market, where it's issued for the first time, okay, and subsequently there is no other market where it can be bought and sold, then it's a non-securities. Okay. And if it is an instrument which has a market for trading, then it's a securities. Okay. When we say trading, we are meaning that at your own will, you have, at your own discretion, you have an option to buy and sell something. You are owner of an asset or instrument, you want to sell it. Okay, there is a ready market where you go and find buyers and you can sell to them. Okay. When you're talking of non-securities, then that is missing. If you want, don't get confused with liquidity. Still, you can go and liquidate your investment, but then you cannot sell it. You have to go and redeem it with the issuer. Okay, or else pledge it, hypothecate it. Okay, to mobilize your liquidity. But then you cannot sell. You cannot change the ownership. Okay, so if you see, there are a lot of such instruments, like open-ended mutual funds, okay, specialized portfolio management services, or insurance products. Okay, You know that there are a lot of insurance policies which is endowment included with term, okay, which has a potential of giving you a huge appreciation on your capital. You take a plan, you contribute a premium of 5 lakh on maturity, okay, you get to 15-20 lakh rupees. So your capital has grown, okay, plus has covered the risk for the entire duration. Okay, but then I cannot sell my insurance policy to someone. So it becomes a non-securities. Okay, but it still serves the purpose of capital growth. Similarly, open-ended mutual funds, okay, we're going to discuss them in detail, but then at this stage we can understand that this is pooling of resource where a lot of people have contributed to a capital and they have been given units. Tomorrow if you need your liquidity, if you need to redeem it, you have to go to the issuer, okay, and redeem through them. Okay, the huge market, again in non-securities would be your bank fixed deposits, bank FDs, a very big market, very big channelizer of resource. Okay, but then I cannot sell my bank deposits to anyone. Okay, but then again I get regular income, I get regular interest on my deposits. Okay, lot of small savings. Okay, lot of small savings like PPF, post office savings, national savings certificates, where small sum can be accumulated over a longer period of time and could create a huge wealth. But then I cannot sell my post office savings to anyone. Okay, so where there is a market for trading an instrument, then it becomes a securities, or else it's a non-securities. But then it doesn't form a part of money market, because money market instruments again can be sold, can be bought, it could be still a securities, but then these instrument has risk inherent in them. It's not risk free. Since they have risk, they have a potential of giving you returns. So the motive of your capital is served. It's only that they are non-securities. Why? Because they don't have a market for trading. Okay, so non-securities are instruments which does not have a market for trading. Okay, so non-securities are instrument that does not have a market for trading. Okay, wherein we talked about, okay, bank fixed deposits, small savings, okay, mutual funds, insurance, and a lot of customized portfolio management services which is offered by industry people. So we have a chapter later in this module where we're going to talk about all individual services offered in the industry. But then at this point in time, we need to understand that capital market is a market which has a potential of your savings to give a growth or regular income. But then there are a lot of instruments which does serve this purpose but does not have a market for trading. So it has to be segregated. Okay, it has to be segregated into, okay, non-securities and then securities market. Okay. So continuing on that, capital market is segregated, as we said, into non-securities and securities. So securities market is a market where instruments can be, any instrument which has a market for trading is securities, and then this is a segment together with some portions in non-securities which is governed by SEBI. Okay, so money market was predominantly RBI's domain, and capital market, okay, leaving aside banking, would be a domain of, okay, and insurance. Insurance is under IRDA. Banking still has RBI's involvement. But then anything other than that, whether it's a mutual fund, whether it's okay, primary issue, secondary issues, secondary markets, trading, okay, all these comes in the preview of SEBI. Okay. So securities market, if a security is issued for the first time, it becomes a part of primary market, and subsequently already issued securities in primary market gets traded in secondary market. Now secondary market, a synonym for secondary market is again stock exchanges. Okay, so secondary market, which we can understand as stock exchange. So already a company comes up with an issue, it's a part of primary market, and then if already issued securities in primary market gets traded in secondary market. If I want to reconstruct and show that, okay, then we said that Indian financial system was broadly been classified as money market, okay, and then capital market. Why this segregation? Because there are different type of providers of capital. Money market for risk free, capital market for risk takers. Now capital market was further segregated into non-securities market and into securities market, okay, and then securities market was again further classified, segregated into primary market and secondary market, okay, and secondary market again can be further segregated as spot, which you understand as a normal stock exchange. We also call it cash market, and derivatives, okay, where you trade for future, okay, and which again derivative can further be classified as futures and options, okay. So this entire domain that we have been talking of is what comprises a financial system, is your capital market. So when you talk of capital market, we are talking from here onwards, okay, but then there is a money market, which we are going to discuss in detail separately as well. So this is what is an overview of a financial system, okay. So the type of question that normally comes, okay, the doubt that would probably pop up, or the type of question which normally one should be focusing on to answer in this segment, or should expect it. It's a concept which probably involves theoretical concepts only, predominantly from this segment. But then this chapter, that is Indian financial system, Indian capital market, together with security analysis, is the most important one, okay. Historically, it has been observed that with your compulsory segment and optional segment, you somewhere get around 25% of marks weightage from this section. So that's why we have started with this chapter, okay. So the type of questions that should come to your mind, okay, is distinguish between money market and capital market, okay, distinguish between money market and capital market, which again you need to understand that to bring out the type of savers of capital in the system, okay, because of people having different motives with the capital, would have different markets to cater. So money market predominantly is a market that channelizes, mobilizes resource which are of preservative in nature, and capital market predominantly channelizes, mobilizes resource which are of okay, risk in nature, which has a potential of giving you a regular income or capital appreciation, okay. And then maybe you can discuss the entire overview, okay, but then it would be a 4 or 5 marks question to distinguish between okay, these. The other frequently asked questions that normally we see from this segment is to describe the objective, okay, what is the objectives of an efficient financial system, okay, where you have to clearly bring out that a good efficient financial system is one which is able to channelize, mobilize every single penny lying into the system, okay, then only savings becomes investment. So predominantly these two, okay, would be your a type of doubt that would probably be coming to your mind, or doubt in the sense that what should be the takeaway from the discussion till this point, okay, and very frequently been asked in your past papers also. So these are the two prominent questions that one should probably, okay, take away from the discussion till this point, that distinguish between money market and capital market. What is the objective of an efficient financial system?